If there is one thing that we all share in common as investors, regardless of our age, risk tolerance, or our investment timelines, it's the very fact that we all want more money in our pockets as soon as humanly possible. I'm talking about like yesterday. And therefore, many of us seek out dividend stocks for passive income. But my friends, my fellow investors, there are just some alternative solutions out there to dividend investing to truly ramp up your dividend income. And not just on a quarterly basis, but every single month. Now, in addition to monthly dividend distributions, the opportunities that I have for you today also dish out higher dividend yields simply because of how they're actually structured in the strategy. And the best part, they are more reliable than just trying to pick a select few of individual dividend stocks, and of course trying to pick the winners, because that's just next to near impossible to do 100% of the time. Therefore, we're going to be talking about exchange traded funds today, meaning purchasing a single share of one of these funds is going to gift you with dozens, hundreds, or even in some cases, thousands of stocks within a single share. That's going to alleviate stress and just gift you with hours of time back that you would otherwise be spending on research, and that's going to reduce also a lot of risk. However, not only are these dividend ETFs, the 5 in particular I'm going to talk about today, monthly paying dividend funds, they're all also shelling out those higher dividend yields, given they are utilizing a covered call ETF strategy, meaning they're going to generate all of us more income. Or in other words, they just hold a portfolio of stocks or other assets and sell call options on those assets, which in turn generate these premiums, which are then distributed to all of us as income. And while I usually veer away from these types of option-oriented funds, exchange-traded funds like the ones I'm about to talk about are actually really insanely good for passive income. But without further ado, let's get to it here with our first fund, which is the Global X S&P 500 Covered Call ETF, ticker symbol XYLD, which, as you can probably deduce from its name, is going to be incorporating the S&P 500 to work its magic. As we can see here, XYLD is all about writing call options on the S&P 500 index, whereas the fund buys the stocks in the S&P 500 and writes or sells corresponding call options on the very same index. Now, we're ultimately talking about roughly 505 holdings within this fund, spread across sectors in the S&P's makeup, literally almost every sector, with Apple, Microsoft, Nvidia, Amazon, Meta, Google, Broadcom, Tesla, and Berkshire Hathaway actually making up this fund's top holdings. Now, in terms of the dividend yield here, we're talking about an 11.7% dividend yield, yet a necessity to note that nothing in life is free. So you're going to be paying a 0.6% fee, which works out to $60 per $10,000 invested annually. But in terms of overall performance, not too shabby if you invested $10,000 into this fund a decade ago and literally did nothing else. You just sat on it. You'd now be sitting on $20,162.16 today. That's roughly a 7.2% average annual return rate. Now, if you were looking to remain within the Global X wheelhouse, yet you want to try to get more bang for your buck, if you will, you might want to look into the Global X NASDAQ 100 Covered Call ETF. That's QYLD. Now, I'm sure you've heard of this one before. It's a fan favorite within the dividend investor community for passive income. QYLD really comes in strong thanks to the NASDAQ orientation. The 100 or so stocks that break down this fund come down to, well, Apple, Microsoft, Nvidia, Amazon, Broadcom, Meta, Tesla, as well as Costco and Alphabet, as we're going to see real serious growth with this fund given that NASDAQ orientation. But what does that mean for you in terms of performance in the ROI? Well, if you invested $10,000 into this fund 10 years ago, you'd ultimately now be sitting on a tad more. It's going to work out to $23,227.58, which is about 8.8% worth of an average annual return rate. All a tad higher of an expense ratio as well, coming in at 0.61%, but on the other hand, a killer dividend yield at 12.74%, which can add a ton of cash flow into your pocket if you're really looking for dividend income immediately. Now, investors, there's 2 out of the 5 monthly dividend ETFs that I wanted to go ahead and break down for you today. But before I cover the remaining 3, which I think are far better funds, I want to actually share with you a pretty good problem that I'm experiencing right now. And it's actually an uptick in viewership, yet not all of those viewers are subscribing. So pulling up some YT analytics, you can see here that 57% of you are actually tuning in regularly, just not subscribing. So what gives? My goal here is actually to just be transparent with you and get that number down to 50%. So if you're one of those view and type of run investors out there, join me now by subscribing to the channel. And while you're at it, you have to let me know that this content is what you're looking for and delivering you with value just by tapping on that thumbs up button, so I know to keep creating videos like this. With that, I want to dive right back into it with the next dividend ETF, that being the more popular pick amongst investors, the JP Morgan Equity Premium Income ETF, that's ticker symbol JEPI, which carries a lot of reliability. Just given the name, JP Morgan is behind it, and ultimately is more of a defensive equity portfolio employing a time-tested, bottom-up fundamental research process with stock selection based on JP Morgan's risk-adjusted stock rankings. Yet, nonetheless, it's using an options overlay strategy, which of course is what this video is about, meaning written out of the money S&P 500 index call options that generate distributable monthly income, with a dividend yield that's going to top 7.12% and only for $35 per $10,000 invested, given that expense ratio is coming in at a lower 0.35%. But in terms of the fund's makeup now, we're going to click back into JP Morgan's fund page to discover that it actually touches multiple sectors, coming in with tech at 14.8% worth of the fund, financials at 13.7%, as well as healthcare, industrials, and consumer staples at 12.6%, 12.1%, and 8% respectively. Meaning we're going to get top holdings like Meta, Amazon, MasterCard and Visa, Progressive, AbbVie, Trans Technologies, NVIDIA, Google, and Thermo Fisher Sciences, all as the top 10 holdings of JEPI. But what about the performance? Well, I'm incredibly happy we're at least thinking it. Now, we're going to go not back to 10 years because we can't, the fund didn't exist, but we can go back about a handful of years, 4 years ago, to discover that such an investment would have actually turned into $17,667.88 if you invested $10,000. It's about 12% worth of an annual return rate. Now, up next, I want to check into the Amplify CWP Enhanced Dividend Income ETF, that's ticker symbol DIVO, which is an actively managed fund. You're going to see how that impacts us in a minute. We're going to talk about quality large cap companies with a history of dividend growth, which in my opinion is insanely important. Now, that is along with a tactical covered call strategy, of course, on these individual stocks. So in other words, DIVO is strategically designed to offer high levels of total return on a risk-adjusted basis. Now, we can scroll down to see that financials will be heavily weighted, coming in at 27.6% worth of the fund's weight, followed by 13.9% of the fund's weight in industrials, and another 13.7% in healthcare. That's before we tap into consumer discretionary and technology, coming in at 12.2% and 10.5% respectively. So a little bit more reliability here perhaps, but the biggest benefit from these companies, well, really is going to come down to investing into United Health, then Amgen, CME Group, Caterpillar, Visa, American Express, Home Depot, Microsoft, Goldman Sachs, and Honeywell. The one drawback that I really see with this particular fund actually is going to loop right back around to that expense ratio that I shared with you I wanted to get to in a minute. When it comes to this fund, is a 0.56% expense ratio. It doesn't sound too bad, but that's $56 per $10,000 invested. We'll get more to that in a hot second. We got a 4.81% dividend yield. And in terms of overall performance and growth when it comes to this particular fund, if we invested that $10,000 into DIVO, did nothing with it, it would have turned into $25,866.36. Well, that also works out to about 12% worth of an annualized return. But investors, if there was one covered call monthly paying dividend ETF that I would personally be all over, I would bring you right back to JP Morgan to share the JP Morgan NASDAQ Equity Premium Income ETF with you. That's ticker symbol JEPQ, which operates very similarly to its sister fund there at JP Morgan Equity Premium Income ETF that we already spoke about a few minutes ago. However, with this fund specifically, it has the sole focus on a strategy that's myopically focused on the NASDAQ. We're tech-centric, and that will ultimately result in more profitability, as we're going to discover shortly. But it is important for me to share one thing with you. I think the future is all tech. And a matter of fact, right now we're seeing that with advancements in AI and quantum computing and just overall moving into a technologically advanced future. That's incredibly important, because this means that if you have the time to actually be invested in technology opportunities and then stomach all the volatility, well, you are going to be rewarded, in my opinion, over and over and over again. Now, JEPQ is going to grant us one heck of a dividend, coming in at 10% as of this recording, while also bringing the expense ratio back down to 0.35%. So again, $35 per $10,000 invested annually, all while spreading shareholders across multiple sectors, not just tech, if you will, but we have technology itself coming in at about 40% worth of the fund's weight before we're going to tap into communication services and consumer discretionary at 13% each. Consumer staples then at 4.1%, and then slivers of other sectors. But ultimately, we're going to be enjoying the gains from holdings like Apple and NVIDIA, Microsoft and Amazon, Alphabet, Meta, Broadcom, Tesla, Netflix, and Costco. Now, I want you to check this out. Performance-wise, well, again, we can't go back 10 years because the fund just was not around. It's a much newer fund that was introduced to all of us just a couple of years ago. It has so far delivered through on one heck of an annualized return rate, 17%, which means that if you had tossed in $10,000 into this fund at the date of inception in 2022, you'd now be sitting on $15,430.67. Not to mention just one heck of a monthly cash flowing machine to capitalize on. But the key to all of these funds, in my opinion, as I always share with all investors, the truth. You got to understand NAV erosion because you don't want to invest in a fund that's depreciating over time just because of a higher dividend yield. And while targeting a higher dividend yield is incredibly exciting, you do have to keep expense ratios in mind. That's incredibly important. For example, let's just say you were investing $5,000 annually and receiving a market average of about 7% worth of a return. You would actually have $25,000 more dollars in your pocket if you invested in a fund with 8.3% expense ratio versus a similar fund with 8.6% expense ratio. So what I'm really trying to tell all of you is just do your math, be smart, and always avoid fees. Now let me know your thoughts on these funds. If you own any of these funds within your portfolio, if you're thinking about buying them, or if you actually have better funds in mind for all of us to check out, comment down below. Be sure to tune in right here if you're really looking for monthly dividend ETFs that aren't not exactly on the covered call strategy aspect of this whole deal. And of course, I'll catch you all in the next video.